Welcome to Talk Tickers, where we give you the essential insights from key earnings calls.
And today we're diving into Wingstop's fiscal first quarter for 2025.
Yeah, the big question really is, can they keep up that amazing growth momentum, especially with, the economy looking a bit shaky?
Exactly. So let's get right into it.
Okay, so kicking off with the results, what's the headline?
Well, it's a bit of a mixed picture, honestly. Same-store sales saw a slight increase, just 0.5%.
0.5%. That feels low for Wingstop, doesn't it?
It does. And they mentioned some reasons: headwinds from things like the California fires, some rough weather in the Southeast.
Okay, external stuff.
Right. And also this general uncertainty. They talked about consumer sentiment dropping quite a bit.
We'll definitely need to unpack that consumer piece later.
Yeah.
But were there brighter spots in the results?
Oh, for sure. Despite that low comp, they had a record quarter for new openings, 126 new restaurants.
Wow, 126. So expansion is still full steam ahead.
Absolutely. And digital sales remain, dominant, 72% of total sales.
72%, that's huge.
It really is. And profitability looked pretty good, too. Adjusted EBITDA was up 18.4%, hitting $59.5 million.
Okay, strong profit growth. What about overall sales?
System-wide sales jumped 15.7% to $1.3 billion. That's actually the highest in their history.
A record.
And total revenue also climbed, up 17.4% to $171 million.
Got it. And there was some noise from a sale, right?
Yeah, a significant gain, actually. $92.5 million from a sale by their UK brand partner, Lemon Pepper Holdings. So that boosted the bottom line.
Makes sense. And earnings per share.
Adjusted EPS came in at $0.99. That's up just 1% year over year.
Only 1%.
Yeah, but that includes a pretty hefty $0.19 impact from increased interest expense. So that held it back a bit.
Okay. That context helps. Anything else on the financial front? Share buybacks? Dividends?
Yep, both. They bought back about 830,000 shares for $250 million during the quarter.
Active on the buyback.
And they approved a quarterly dividend of 0.27 cents per share.
Okay, so looking ahead, what's the guidance telling us? Did that softer comp flow through?
It did, somewhat. They revised the full-year domestic same-store sales growth guidance down. It's now expected to be approximately 1%.
Just 1%. So they're signaling a tougher domestic environment for the rest of the year.
Seems that way, yeah. But interestingly, they actually increased their global new unit growth guidance, now 17%.
Higher unit growth. Okay, so leaning into expansion even more.
Exactly. That implies maybe 410 to 435 net new units globally for the year.
And any updates on interest expense or overall profit growth targets?
They expect net interest expense to be around $40 million now, but the adjusted EBITDA growth rate target, that's still holding at 15% for the year.
Okay, still aiming for 15% adjusted EBITDA growth despite the lower sales comp guidance. Interesting.
Definitely. Suggests confidence in margins and maybe the contribution from new units.
Right. So let's dig into that macro environment piece. You mentioned consumer sentiment. What exactly did management say?
They were quite specific, actually. Described 2025 as a dramatically different operating environment.
Dramatically different.
Yeah. Pointed out that consumer sentiment is at its second lowest level since 1952. I mean, even lower than during the pandemic.
Wow. That's stark. So how are they seeing that play out in their business? Is it hitting everyone?
Well, that's the interesting part. They don't think it's broad-based. They see the pullback really concentrated in certain geographies.
Okay.
And specifically impacting the Hispanic consumer and lower middle income demographics more.
So targeted weakness, not a general collapse in demand for their product.
That seems to be their read, yeah. And they actually said it feels similar to slowdowns they saw back in 2017, 2020, and 2022.
And they navigated those periods pretty well, didn't they?
They did. So the implication is, they believe their model has some resilience built in for these kinds of conditions.
It was okay. Despite that caution, though, their long-term goals seem unchanged. Still aiming high.
Absolutely. They reiterated the big targets, scaling average unit volumes, or AUVs, up to $3 million.
3 million AUVs. That's a big jump from where they are now, isn't it?
It is. Current AUV is strong at over $2.1 million, but yeah, $3 million is the goal. And the other big one is expanding the footprint to over 10,000 restaurants globally.
10,000. Okay, so no scaling back on ambition there. What's the strategy to get there?
It's multifaceted, really. Key things they mentioned are scaling brand awareness, getting the Wingstop name out there even more,
Makes sense.
driving menu innovation, keeping things fresh, expanding delivery further, using data-driven marketing more effectively.
Leveraging that massive database they have.
Exactly. And just continuing that digital transformation journey. It's a comprehensive approach.
And it seems to be working on some level, right? You mentioned brand health metrics were strong.
Yeah. Really strong, actually. They said guest scores and survey data show brand love is at an all-time high.
Even with the wider economic gloom.
Apparently so. Record levels on their brand health metrics, which they noted contrasts with declines seen in broader restaurant benchmarks.
Interesting. So people might be cutting back elsewhere, but they still love their Wingstop.
Seems like it. And they also mentioned March was their biggest single month ever for acquiring new guests.
Wow. Okay, so the underlying brand appeal seems intact, maybe even growing.
That's the picture they painted.
And that clearly ties into the development piece. Record openings, you said?
Yep, 126 in Q1 exceeded their own expectations. It really shows the momentum and, frankly, the demand from franchisees to open more stores.
And how are these new stores performing? Are they opening strong?
Very strong. The average new restaurant volumes for the latest vintage, as they call it, are on pace to exceed $1.8 million.
$1.8 million out of the gate. That's impressive.
It really is. And the pipeline looks healthy, too. They started the year with commitments for over 2,000 future restaurants globally.
2,000 committed. That's huge runway. Where's the international demand coming from?
Seems pretty widespread. They highlighted a record-breaking opening in Kuwait recently.
Kuwait. Interesting.
Yeah, and Australia's launching soon. Q2, actually. They're anticipating entering up to 5 new international markets just in 2025.
5 new countries this year. Okay, global growth is clearly a major focus.
No question about it.
Let's shift to the menu. They relaunched crispy chicken tenders. What's the early feedback there? Is it moving the needle?
Early signs are promising. Seems like it's bringing in new customers, which is always good.
What kind of new customers?
They noted it's attracting similar behaviors to what they saw with the chicken sandwich launch initially, more individual eater occasions.
Okay, so maybe grabbing some lunch traffic or solo diners.
Potentially, yeah. They see tenders as a meaningful adjacent demand space, something different from wings, but still core to their brand.
And you get them in all the flavors.
That's key, tossed in any of the 12 flavors. And early data suggests the sales are pretty balanced across different times of day, too.
Okay, so appealing throughout the day. Sounds like a solid addition.
Looks that way so far.
Now, technology.
Mm-hmm.
The Wingstop Smart Kitchen. This sounds intriguing. What exactly is it?
It's essentially a new kitchen operating platform. It combines a few things. AI-driven demand forecasting.
Okay, predicting order flow.
Right, a gamified kitchen display system for the staff.
Gamified to make it more engaging for employees.
Seems like it, yeah. And also customer-facing order status screens so you know where your food is in the process.
Like you see at some other fast casual places. What are the results so far?
They've rolled it out to over 200 restaurants already, and the early results are pretty striking. They're seeing consistent order times cut in half.
Cut in half. That's huge for throughput and customer satisfaction.
Absolutely. And they said guest satisfaction scores are improving in those locations. Plus, those restaurants are actually outperforming control restaurants on sales.
So it's driving sales too, not just efficiency.
It appears so. The plan is to get it rolled out system-wide by the end of the year.
But that potential upside isn't baked into the current sales guidance.
Correct. They explicitly said the smart kitchen benefits are not factored into that approximate 1% same-store sales guidance.
Okay, so that could be a potential source of upside later in the year or next year.
It certainly could be, yeah.
And sticking with tech, they have this massive database, Wing ID, over 50 million users. What's the plan there?
Loyalty. They're planning to pilot a loyalty program in Q4 of this year.
Finally. People have been waiting for that.
Great. With a plan for a full system-wide launch in 2026.
What's the goal with the loyalty program? Just driving frequency?
Frequency and retention, yeah. Rewarding that repeat behavior, but also using all that data they have on those 50 million users.
For personalization.
Exactly. More personalized offers, experiences, really leveraging those insights.
Makes sense. That digital foundation is a real asset.
Definitely.
Let's talk about the franchisees, the brand partners. The unit economics sound incredible.
They really are industry leading. They talked about unlevered cash-on-cash returns of around 70%.
70%.
Unlevered.
Yeah. That's pretty remarkable for the restaurant industry. It shows how profitable the individual units are before debt.
What drives that? Strong AUVs.
That's a big part of it. Those AUVs over $2.1 million. Plus, they highlighted predictable food costs, which helps a lot. So franchisees are making good money.
Record cash flows, according to the company. And that's what fuels the demand for growth, right? That's why they could raise the unit growth guidance. Franchisees want more.
Right, the economics pull the growth. Okay, let's circle back to the sales guidance. That 1% domestic comp for the year. Could you break down the cadence? Why so low, especially after recent years?
It really comes down to the comparisons. The first half of this year, especially Q2, is lapping incredibly strong growth from the past couple of years.
Is the post-pandemic boom.
Exactly. Q2 2025 is up against a 2-year stacked comp of 45.5%. That's just a huge number to beat.
45% over 2 years. Okay, that makes 1% seem more understandable. What are they seeing right now at the start of Q2?
They indicated that the trend at the start of Q2 was actually a mid-single-digit decline in same-store sales.
A decline. Okay, so Q2 is likely to be negative year over year.
That seems probable, given the comparisons. But they do expect things to improve. They anticipate getting back to growth in the third quarter as those comps start to ease up.
And again, no Smart Kitchen benefit assumed in any of that.
Correct. That's potential upside not reflected in the guidance.
Okay. What about international sales? Are they seeing similar trends?
Actually, no. International seems to be a real bright spot. It's currently exceeding U.S. same-store sales growth.
Outperforming the U.S. and record unit growth there too, right?
Yep, record net new unit growth internationally in Q1. Those new markets in the GCC, the Gulf region, are apparently doing very well.
And Australia coming soon. What about huge markets like China or India?
They still see China as a big long-term opportunity, but given the current geopolitical environment, it's not a priority right now.
Understandable.
But they did specifically highlight India as another significant long-term growth market they're interested in.
Okay, so lots of international irons in the fire.
Definitely seems like a key part of the future growth story.
Lastly, advertising and brand awareness. Any shifts there?
They did increase the advertising fund contributions slightly, up to 5.5%. Part of that is to cover operating expenses for the Wingstop digital platform.
Okay, funding the tech. What about partnerships?
The NBA partnership seems to be paying off. They said Wingstop was the most seen brand during NBA games this season.
Really? Most seen. That's effective.
Seems so. And they're looking beyond basketball, too, exploring potential partnerships with WWE and UFC.
WWE and UFC. That feels very targeted towards a specific demographic.
Exactly. Reaching their core demographic, but also trying to connect with people who maybe have lower awareness of the Wingstop brand right now.
Makes sense. Okay, that's a great deep dive into the quarter and the strategy.
Lots to unpack there.
Absolutely. All right, now for our favorite segment. This is not financial advice. After digging through all that, what's an outrageous but plausible trade idea you've cooked up?
Okay, so thinking about Wingstop, you've got this clear acceleration internationally, right? Kuwait doing well, Australia about to launch with a big commitment.
Right, the global story is strong.
But you've also got these near-term domestic headwinds impacting the same-store sales guidance, which might be weighing on the valuation a bit right now. So here's the outrageous but plausible idea. Consider a long position in Wingstop, but pair it.
Pair it with what?
Pair it with a short position in a more mature, mostly domestic quick service restaurant chain. One that maybe doesn't have much international growth runway left and trades at similar valuation multiples.
Okay. So long Wingstop's global growth, short, a mature domestic play.
Exactly. You're betting on Wingstop's international expansion potential while hedging against some of those ongoing domestic macro concerns.
What makes it outrageous?
Well, the outrageous part is really betting that Wingstop can significantly outpace this seemingly more stable, established domestic player over, say, the next 18 to 24 months.
Driven purely by that international growth and the strong unit economics attracting global franchisees.
That's the thesis, yeah.
Okay.
Capitalizing on that high-growth global story while acknowledging the near-term domestic choppiness.
Got it. A classic pair trade structure focused on divergent growth paths.
Precisely. But, and this is crucial, this is purely speculative just for discussion, it is absolutely not financial advice.
Definitely not. You absolutely need to do your own thorough research before even thinking about making any investment decisions. This is just informational.
Couldn't stress that enough. Do your own homework.
All right. So that was our deep dive into Wingstop's latest earnings call. We've unpacked the results, dug into their strategies, The consumer environment, the tech, the global push.
And even floated a potential trade idea for you to mull over.
Hopefully, this gives you a much clearer picture of where Wingstop stands and where it might be heading. But remember, this is just the start.
Yeah, we encourage you to dig deeper into the aspects that caught your attention. What stood out most to you? What questions do you still have?
Let us know what companies or calls you want us to unpack next time. Join the conversation.
Thanks for tuning in to Talk Tickers.